Well, welcome to the show, Rapha.
Thanks, Eric. It's a pleasure to be here. Thanks for the invite.
Just as a quick overview for those that are watching, I am joined with my amazing guest, Rapha. He has been building applications, Bitcoin-related applications in Stacks for the past few years. He is a prolific developer within the Stacks community. Everybody knows him within Stacks. He's a huge Bitcoin advocate, as well as just a big Bitcoin ecosystem advocate for all things that you can do with Bitcoin and stretching the use cases for Bitcoin on different layers. And the thing that we're going to be going over today is exactly one of his most popular applications at the moment. It's called JingSwap. And with JingSwap, what we're going to break down is, well, one is what is JingSwap? Two, how do Bitcoin swaps work? Three, which is going to be, for the most part, the theme and focus of this show is breaking down how he is able to integrate Pyth for his Bitcoin swaps in the JingSwap application. And then lastly, he'll be sharing any technical lessons that he learned for any new developers or any existing developers within the Bitcoin and Stacks ecosystem for him to share. So, yeah, I'm excited for this, Rapha. I don't want to get too much into, well, let's do it anyways. Give us a 1 minute Eli 5 overview of who you are.
Okay. Yeah, I'm Rapha, the founder of JingSwap. I have a background in finance, and I was a co-founder of a hedge fund in New York City. Built that for a couple of years with a friend and separated on amicable terms. Then I discovered Stacks and Bitcoin, and I never looked back from there.
And I think your background is going to be immensely really important for the things that you've been building, especially when it comes to like these applications for entities and institutions and in different DeFi kind of use cases. So yeah, let's get into it. So give us the Eli 5 on what JingSwap is.
Yes. So JingSwap is, I would say, currently the only venue on Bitcoin L2 Stacks where you can swap $50 or $50,000 and you'll get the same price. You'll get the exact Pyth Oracle price. That's pretty much it. So that's the mission.
And then, so how is this in comparison with other swap applications?
So I would say that it's bringing volume that historically is not swapping on chain. It's not swapping on Stacks L2. It's going to centralized exchanges. And the reason for that is basically if they were to swap on Stacks L2, Bitcoin L2, they you can see some of them actually. So these whales are the initial target segment. You can see that some of their swaps, $10,000-$15,000 worth of a swap. So typically here you can see this whale watcher is watching whales that need to swap from Bitcoin to Stacks via the one-to-one backed SBTC, official wrapped token on Stacks L2. They typically don't do it on chain. Like this is a minuscule amount of a swap volume that is being done on chain, and when it's done on venues otherwise than Jing, they essentially lose, typically 2% just because of the mechanism itself and the lack of liquidity. So you have to understand that AMMs, the way AMMs are built is constrained by the liquidity in the AMM. It's a very smart mechanism, but by design, it's going to swing. It's going to swing on a bonding curve. So if you are a whale, like say like I'm 5 years old, right? If you're a whale and you jump on in a swimming pool and there's not enough liquidity, you're gonna hit the bottom and you're going to lose, this percentage, which over time compounds. So it actually makes no sense for them to swap on chain because at least currently there isn't the liquidity. But the same problem is going to scale over time as Stacks L2 attracts more institutional grade investors. You'll have like bigger and bigger whales. So the problem will remain. And so far, we've catered, for example, one of our stacking pool, right, who has that need. Every cycle they get the SBTC yield from the proof of transfer on behalf of the stackers of the stackers in the pool, and these stackers want the reward in STX. So they have the need to swap. I think in the 47 days that we're launched, one of our stacking pools have done 12 swaps around $90,000, and they saved, 2%, around $2,000, which again over time it's going to compound.
So if I can summarize a little bit as to the whole purpose and advantage of JingSwap, especially for people that are not really familiar with institutional kind of swaps, or like swaps that deal with a huge amount of assets, right? I mean, for the most part, whenever I'm swapping assets, it's usually just either like $50 or a couple $100, right? So JingSwap allows a whale with a large amount of assets to swap their assets, currently at the moment on stacks, so that essentially they basically experience zero slippage on their swaps. Is that correct?
Yeah, exactly. So again,
And
if you swap $50 or, in this case, $25,000, you will get, as you can see, for example, Jing Oracle price 307 Satoshis per STX. That's the exact swap you see, the exact rate you see. The Oracle price is the rate that you get. That's it. Whereas on the AMM, as you can see, the rate is going to swing against you. Depending on which side you are, it's going to be lower or higher, right? But it's going to be a little less advantageous for you because of this, liquidity constraint that I'm trying to explain, and the bonding curve mechanism, which is it's working as designed. But if the liquidity is too small to cater for your swap, then you'll incur a significant amount of slippage. So we're talking $20,000, but I've never seen any larger swap than 25, or like, let alone $50,000. And the simple reason is because if you were to swap that in one go, you would incur that even a higher slippage, 5%. So we're talking thousands of dollars just lost because of that constraint. So they simply go, our whales, our own whales, stacking pools, right? Stacks miners who get the Coinbase reward in STX, and they need to swap it back to Bitcoin so they can, commit Bitcoin back into the POX mechanism. Our own whales are going to centralized exchanges, and the number one mission was to cater for real users, our own whales, and give them a venue where they can actually come back and swap on chain and don't lose any money on the swap.
and in this entry example that we've been talking about, what is this number right here representing at the bottom right?
Sure. So this is the difference between in this case, this swap was swapped on Jing. So the rate 307 sats per STX, that's the exact rate of the swap. You can do the division and you'll get that number between the output and the input, obviously, right? That's the rate, simply put. And the AMM's rate equivalent is a historical estimation. We are observing all of these swaps that happen on AMMs, right, for similar sizes, and then we estimate how much would have been that rate. And then if you do the difference times the size times the conversion back to fiat, the dollar, that's how much you lose in dollar terms. $1,000 for $25,000 worth of swap. So
Okay.
obviously this is going to improve, right? I just want to say that out
Yeah.
loud as well. I think it's important to say that we have venues out there like AMMs, which are very smart and they're gaining traction, hopefully. But in the meantime, this allows our own whales to come and make their own market directly on stacks rather than having to go to a centralized exchange, which has other benefits. I can talk about the other benefits as well.
Let's hold on that for now. I think for the most part, we've got the mission statement and the value proposition for JingSwap already settled. Let's now dive into the code and kind of give a technical breakdown as to how you're actually pulling this off. Because I think this is a really interesting use case, especially for, like you said before, right? You want the same players that are participating in the Stacks protocol to stay within the Stacks network for any of their DeFi kind of use cases. I want to first talk about the actual flow from when a whale initiates a swap and then settles that swap.
Let's do it.
All right, so up here on your repo, if anyone wants to navigate to this is on Rapha's GitHub repo. He has the current existing contract that is pertaining to many of the current swaps that are being performed on his application. It's about what, 500 lines of code, I believe. By the way, how long did it take you to write this all up?
So I actually work in iterations. So I have a first version that does the job. And then typically, obviously, every line of code for a smart contract is going to be humanly verified, right? AI is always helpful. But when we're talking smart contract in finance, as I said, I have a finance background, and so in my hedge fund, we never ever had lost any significant money, which is the number one rule in finance. Like, don't lose any money. But I would say in DeFi and in smart contract finance and Bitcoin Fi, the number one rule for developers is you know build with security in mind. Like, don't have hacks. It sounds like blunt, that don't lose money, don't have hacks, right? It doesn't matter what you do, obviously do the best that you can, review every line of code, battle test, unit test coverage, and more, right? Peer reviews, audits, and so on until, over time when you deploy it and it becomes battle tested over time, nobody's able to, nobody has been able to, extract any value from the contracts, touching wood. But that's because you actually, do it seriously.
Well, amen to that. I don't want to lose any money if I'm using JingSwap. So,
It's
uh, yeah.
especially for like an indie dev, right? If you
Mm.
have one hack, it could end your career, right? If you are VC backed, maybe you can make users whole, and then patch the vulnerability, and then your contract becomes battle tested over time. But if you're starting like I am, this is crucial.
Now, on the note of being crucial and paying attention to details, let's go through the deposit flow first, right? This is obviously when a user initiates a swap. They're going to be transferring their asset to somewhere, essentially depositing it to this contract. So here is this function for depositing. We're not going to go through it line by line, but I think for Clarity developers and just smart contract developers in general, I think it'll be nice if you can kind of give like a high level overview of the flow and then point out any unique aspects of this function, such as perhaps like the usage of calling the SBTC token contract. And then I think there's also the logic of like kicking off or bumping the smallest depositor
Yes.
in the list of depositors. So yeah.
Yeah. So let me give you a high level understanding of what it's going to do. So you come to the JingSwap app, and the mechanism works like this, right? You want to swap SBTC for SCX if you're a stacking pool. So you're going to deposit SBTC, and then the contract is going to look at how much SCX there is. If you want to swap $20,000 of SBTC and there's $20,000 already in the contract of SCX, no problem, right? You deposit, you close deposits, and we can go into details, and then you settle at the Pyth fresh Oracle price. So if there's $50,000 on both sides, it's going to essentially take your SBTC, give it to the depositors of the STX, and the depositors of the SCX is going to their STX is going to be sent to your wallet, right? And yeah, so this is how it works essentially, meaning that this is a just-in-time venue, right? Typically, when you arrive, there's one pool that is full with assets, and the other one is empty. So if you're depositing in that empty pool, you have a guarantee of being able to swap as long as there's as much, in dollar terms, as much of the other asset that you need. And if there's not, then the other asset, the other pool is going to be completely binded, right? After the cycle, that is going to be reduced to zero because they are completely filled, right? And the part that is not filled on your side is going to roll over to the next cycle. So that's the overall view of how JingSwap works. Now, when it comes to the deposit, as you mentioned, there's a important mechanism here, which is the smallest depositor is going to be bumped out of the pool. So the way it works in Clarity here is that you can think of this as like two containers with slots. And these are the two pool assets, right? SBTC and STX, right? So in the SBTC side, there's 50 slots. So if you have 50 depositors, you can still deposit, but you have to deposit more than the smallest depositor. And if you do, then you enter the cycle and the smallest depositor is bumped and refunded of their deposit. Does it make sense?
It does
So
make sense. If I
yeah.
can have a side question real quick, what is the point of this anyways? Why not just have like a 50 slot limit cap and then, like a first and like, yeah, what's the phrase called? First come, first serve kind of basis. Like, well, why kick off the smallest depositor?
Yeah, so you have to come back to the initial problem, which is typically also, I didn't mention that, but as a whale, if you want to swap a large amount, not only you have slippage, so liquidity constraint, but you also have MEV, meaning miners are able to reorder transaction ordering, and then essentially front run you and then sort of dump back into you. And so they capture a spread on you. This is impossible with this mechanism. It's a batch auction. So you've got 50 depositor limit on one side, 50 on the other side. And then they all get the same price, no matter what. And then the reason why it's limited, yeah, that's pretty much it, right? You could have larger limits, but then you have things like cost, right? Cost for clearing all of this, right? The blockchain itself is going to have running costs and so on. So this is it's pretty cool. It's pretty good. And even if you bump now, you just deposit in the next cycle and you're still in the pool and you still, but this is again in mind is also to cater for whales, right? Whales who cannot afford the MEV. So that's why, a larger depositor is going to have priority, so to speak. But in practice, you deposit and you're going to get swapped.
Okay, that makes sense. So to continue forward, so that was the deposit flow, right? Essentially, user will deposit their assets, the one that they want to swap out of, and the contract will basically determine this like smallest amount. Whoever the smallest depositor is, they'll kick them off and kind of carry them over to the next cycle. And then after this step is when the settle and close flow will happen. Now, I think this is
Yeah.
this part right here that coming up, the settle and close flow is the one where I think we should really get deep in the details because it's utilizing the Pyth contracts for it which is essential for guaranteeing that Pyth Oracle price for the assets that you're going to get swapped into.
By the way, this is already old code. We already have a V3 code that anonymizes all the tokens, and in Clarity 5, you can actually do things like contract call constant, which is it's easier to read, right? And also something we could have mentioned in that deposit function is the in contract post condition, making this contract very safe. So actually, no, that's not in the deposit, but in other function, there is such in contract post conditions where,
Gotcha.
the contract itself is going to be isolated from proxy attacks and so on. But just a parenthesis while you crawl to the close and settle with refresh function.
Gotcha. That's a good call out. And that's always the problem with creating technical content with developers. Cause honestly, the next month, all this stuff might even be outdated, right? There's just new code every month being shipped. So yeah, let's get into the close and settle flow. It's the entry point is right here in the contract on line 547. Now this part is a little bit more in depth, and for it, we can actually step through it with this diagram that I have set up over here. So, and I think this diagram does a really good job of kind of understanding and breaking down the flows when it comes to like, determining the Pyth Oracle price and
Yep,
when to settle and the different safety checks also that you've implemented in that function. So let's start from the top. Let's start from the top over here.
sure. So you deposit your asset, and then there's a step that closes the deposit. So when you deposit the asset, it bumps the smaller one if the 50 slots are filled, but you're bigger than the smaller one. And then the next step is to close the deposit. Why do we close deposits? There's a security feature here where we're going to roll over depositors that are still 0.2% smaller than the larger depositor as comparison as the larger depositor. And the reason is we don't want them to settle at a price that, because of the rounding error, they would get a price that is not the exact Oracle price. That is disadvantages. So we're simply those who are 0.2% smaller than the larger depositor, they're rolled over to the next cycle, right? Again, I think this is prioritizing the whales, right? And this is protecting the smaller. the smaller depositors, right? Because you can deposit your amount and then at the last minute, a huge whale comes in and deposits a huge amount. And now you're less than, 0.00 something percent. And then in the calculation, the mathematics, you're going to, because of the rounding error and clarity, you're not going to get the exact Oracle price. And we don't want that for you, right? So that's one of the reasons why we close deposits. So we do this operation. And then finally settle with refresh. We can go to that now. So settle with refresh. So this is where the settlement moment is going to actually do its job and move, the SCX to the SBTC depositors and the SBTC to the STX depositors, and then roll over any amounts that are not filled on a binding side, right? There's going to be one binding side, meaning in the next cycle, that side will get 0 because it will be 100% filled. And in the case of a, Bitcoin to STX market, we're leveraging both the price of Bitcoin and the STX at the Pyth Oracle and deducing the, at Bitcoin to STX, right? Price. This price needs to be, fresh, less than 80 seconds. Fresh, it used to be in V2 60 seconds. But in V3, the entire process can be atomic. So we gave that little leeway of an 80 seconds, which is standard. Like, I know that Zest is doing like 120 seconds, for example. Yeah, so we get that freshness, that fresh price. If it's not fresh, then it asserts out. We also are going to check on the confidence interval. So Pyth is gathering, is providing an Oracle price with a Pyth interval confidence, meaning that all the venues, they aggregate, price amongst all venues, and these venues need to be essentially within that 2% range. If that's the case for both prices, we proceed. Otherwise, again, settlement will not go through. That's okay. We compute the clearing price. We do also a safety check that's a bit lower. That's in V2. Right? In V2, so that's, I was explaining safety check, freshness, confidence. And then in V2, we were also being a little paranoid in the sense that we were checking that, okay, Pyth's price is aligned with an AMM price, in this case, Bitflow. And we had a max deviation of 10%. We want both price to be within 10%. Otherwise, it's a bit paranoid, because typically a Pyth price will be more robust than a Bitflow price. Right? Bitflow is an AMM. It can be manipulated. It has less liquidity. Pyth is going to aggregate across venues. In V3, we've replaced this deviation check with a limit price for a user. So that's even a stronger guarantee that the user is going to deposit. In the moment they deposit the asset, they also set a limit price, which is the maximum price they are willing to settle at. And so the Oracle and the mechanism is going to check whether that limit price is violated. If it's violated, you don't settle this particular user. If it's not violated, then proceed. Meaning that it's even stronger because if your limit price protects you at the end of the day, it's really strong, right? Even if Pyth goes north or crazy, the clarity code is going to verify, okay, Pyth is not violating your limit price, therefore proceed. It is violating, then roll over this particular user to the next cycle. And finally,
okay, can I pause right here? So I want to go back to the Pyth integration design feature. Because I think this is really a huge pivotal pillar of what's going on behind the scenes in JingSwap. But the first question is, why did you choose Pyth over other Oracle solutions? So in Stacks, I do know like there might be 2 other alternative options for getting Oracle prices. I think the other one is from Dia, and then there's another one managed and hosted by the Stack and DAO team. So why Pyth?
To be honest, Pyth is just recognized as a very reliable global price. It for the Bitcoin price, it aggregates across tens of venues, centralized exchanges, and it's also trusted by the best teams outside of Stacks and inside of Stacks. I think Zest uses Pyth, but they also have a backup with Dia, I think. So as a developer, I didn't do much research on this. I just went the best recognized Oracle and then let's put on all of these customized, protocol, bounded, protections. The last one in that I did is obviously the user's limit, which for me, it makes me very confident I can sleep at night. The user is going to set their limit. So there's two aspects to it, right? The limit can be in range or out of range. If it's out of range, meaning your limit price is under the Oracle price, so currently it's not settling. You have deposited your amount, and then the Oracle price has to come to you to not violate your limit price, and then you'll be settled. Or it can be in range, meaning your limit price is maybe a little above the Oracle price, so you are guaranteed currently to be settled. But if the Oracle price goes crazy, or even the normal price, right? If the price goes against you by a lot, you will not be settled unless it doesn't violate your limit price. So long story short, I don't really have a consistent, like a very sustainable, like very robust answer for that question, other than I added additional protection that makes me feel like very confident with this.
And then that's honestly, that's a valid response too. In the Stacks documentation, there is a guide for using both Pyth or Dia, whichever one you like. And I'm pretty familiar with the flows for both of these because I wrote these guides. And also props to you, Rapha, because you were also inspirational for me writing up this Dia guide too. I think this was about like a year ago or something. But it's interesting as well because actually using Dia within your Clarity smart contracts is a bit easier. It's a bit seamless. There's less moving parts as compared to using Pyth. So it is kind of interesting from your developer's point of view of how, for the reasons you stated, right? Pyth has a bigger brand name. It's more trusted. It's battle tested in a certain way that maybe Dia isn't. But despite the more moving parts that you need in your code and whatnot, especially, fetching the VAA on the front end, and then checking the intervals and the freshness time, it is interesting how developers would still gravitate towards using Pyth within their contracts.
I think I can push back a little bit. I think Dia have an excellent customer service. Shout out to Brian, I think. And I'm interested in working with them for cases perhaps where they have more flexibility to provide a price. And again, by using these custom security within the contract allows me to actually be confident also by using a different, like less notorious, less prestigious Oracle, especially if they provide uh, uh, you know new stuff like novelty, right? But for like whales who are swapping $20,000 typically, or even bigger as Stacks scales, I think Pyth is just a must.
If I can sidetrack here for a second. So we talked about it before this recording. What are your thoughts on, and if you're okay with it too, we can leave it in the recording. What are your thoughts on what happened with Velar
Sure.
and the whole mishap with their Pyth integration within their smart contracts?
Yeah. So I want to preface this by the fact that I'm not privy to any, I wasn't part of the team. I didn't do any sort of deep dive into any of their code or material, but I did see what contract they use for the Oracle. And they used, I believe, Pyth, but they had a monotonicity, I don't know how to pronounce this word, like monotone check, meaning that you are going to record a price, and that price should be fresher than the last recorded price, which is a very loose check. What we have in JingSwap is, freshness must be 80 seconds versus the Stacks block height timestamp, and price must be within 2% of the interval. I'm just repeating, and it should not violate the user's limit. It's very strong security gates. They didn't have any of that. They were just saying, if this price is fresher than the last price, then proceed. And this is problematic, especially in an environment where their product, a perp dex, didn't have much activity. So if the last price was an hour ago, now any price from now to an hour ago is accepted by the system, which is very problematic because you can now pick the lowest price for the past hour, buy at this price today, right now, knowing that the price right now is, the price that it is, and it's higher than the lowest price from within the 1 hour interval. And then you sell in the next block and you capture that difference. And then very quickly you can actually bleed out the house in the case of the perp decks, right? The house is sort of a pool that is trading against you, and you're always winning against the house. And it's almost in poker, there was a very known hack, I think in the 2000 in a website, where someone had sort of root access to the cards and they could see the cards. So if you can see the cards and you're playing poker, you're going to bet when you're winning, you're going to fold when you're not. You're guaranteed to win every time. This is what is happening, or has happened with unfortunately, the Velar hack, and $700,000 of the house money was depleted on stacks and also on the other Mesos layer to MEV compatible. And
Okay,
honestly,
that's
like,
yeah.
yeah, it's honestly this is controversial, but I would say developers have to be humble, and I don't see that humility being projected by the Velar team. I don't see it at all, and I think it's doing a harm to the rest of us. It's really harmful.
Did they? I do believe they did put out some kind of like post mortem about what happened afterwards. Do you know what their current status is at the moment?
So I have no idea, but yeah, I think that, they had the money, they were VC backed, they were audited. The auditors pointed out about this
They did.
Oracle
Oh, okay.
uncertainty. Not the exact same contract. They had a testnet version of it, and they said, this is an issue. There were several issues. You can read the audits. In my opinion, this is I mean, in perp dex land, just like JingSwap, the heart of it is the Oracle price. It's the heart of it. This is not serious at all. This is lack of humility, in my opinion. It's not just an something you forget. This is the heart of it. You cannot do this. It's hurting the rest of us and the ecosystem itself, who's lost. The house money was lost, and the trust in the team is lost, in my opinion. At least on my side.
Well, thanks for sharing that feedback. Yeah, it's definitely a good learning lesson for any developer that wants to integrate Pyth within their Clarity Smart contracts. Just essentially, the more checks, the more limits, the more gates that you can have, the better, essentially. And I think that's what you've implemented in your contract. Now, like you said before, you took out the bit flow check, and instead replaced it with better user limits, right? If somebody were to want to use BitFlow within their contracts, is that essentially, so for a developer, is that essentially like they're providing, do they have functions within BitFlow's contract so you can just call for checking their prices on their dexes?
Yeah, I think this was an initial good idea to have like this sanity check against the price of Bitflow on chain. If the Pyth Oracle price, for some reason, you always want a backup, a security after the security, so that there's no surprise, especially for the heart of it. And to be honest, the Velar hack was one of the motivation for me to build this and leverage Pyth. But how do you do it? Well, it's pretty simple. You can call the XYK Bitflow Uniswap V2, and it gives you the inventory of the assets, and the price is a simple division. And then you can also call the active bin of the concentrated liquidity, and also gives you a price. So you can compare this price with the price that Pyth is giving you, and then simply put, this is just arbitrary. Is this price sane, right? Is it sane? Is it within a 10% deviation? Okay, let's proceed. If it's beyond that, there's a problem either with Pyth or with Bitflow, but I don't want to settle at the price. But as I said, I think now the per user limit price is even stronger. The user is now signing their price. I will not get settled worse than this limit price. I don't care what Pyth says, even the freshness or the confidence. This is the user stating their worst price. And the contract is going to respect that. It's going to filter out any price that is violated and rolled over into the following cycle, and only settle the ones that are in range.
Well, I think that was a really good, thorough breakdown of the flows of swapping on JingSwap. And the takeaways and the lessons learned from using Pyth is, I think, crucial for any new developer that wants to integrate Pyth with their Clarity Smart contracts. So for any developer that's watching, they can head to Rapha's repo up at the top over here, and check out some of the other contracts that he's been iterating over the past few months. And I believe the newest iteration is V3, which should be coming out sometime soon. Maybe we can talk about V3 and the new features that are being shipped for JingSwap in V3.
The code for V3 is almost identical to the code for V2. It's just an iteration of it. And again, like the Bitflow check is swapped with the limit price per user. It's also token X, token Y. So it makes every contract byte identical. And so you can actually register a contract, make sure that the hash is actually canonical. And then you can essentially deploy other markets using Pyth Oracle or even DI if you wanted to. So that's one of the advantages of V3, I would say. In V3, we're also shipping an entire execution layer, but very simple one. And the idea is, when you deposit or you swap on Jing, your limit price is public. It's seen in the contract. What you could do instead is you deposit your asset that you want to swap in a vault, and then you sign off-chain messages, which are policy or bounds or limits and expirations that a keeper can execute on your behalf using that vault. And this way you don't need to babysit any contract. And also the keeper can execute you across venues, not only on JingSwap when the liquidity is there, when the Oracle price is better, but also on Bitflow. It could chunk your amounts in smaller amounts where you don't have as much slippage because now the liquidity is not going to swing you so much. And over time, it can execute your strategy without you displaying that limit price, that signature is off chain and only your keeper has it. So that's one idea. Another thing we're shipping, and this is all alpha, is a feature we call swap now, pay later. The idea is for a stacking pool to swap at the current rate, currently on Jing, because they see the liquidity at a lower price. Let's say the price is really good, they want to swap, but they don't have the SBTC yet. So there's a lender who is going to lend them the SBTC, they swap, and then when they get the yield from stacking pool, they can pay back the lender. So everybody's happy. The stacking pool locks in that lower rate, and the lender gets, a 1% or 12% equivalent, and still everybody is happy with the math. That's another thing we're shipping.
For those keepers, that sounds very familiar with what Bitflow released last year in terms of those Bitflow keepers smart contract wallets. Is that like using the same kind of premise and design?
So I did talk to Dylan, the developer at Bitflow, and try and ask him questions about how he architectured it, more on the how the off-chain messages are stored, so to speak. But I didn't go into their contract, so I cannot exactly tell you whether it's close or not. But I did work with the developer at AIBTC, and they also have a sort of similar vault system. Yeah, the way Jing is built is leveraging SIP18 message. So you sign a message, and when you give that to the keeper or your AI agent, and that message has a limit price, it has an amount, it has an expiration, and that message can execute on the vault, and the swap can happen on Bitflow or on Jing. It doesn't matter. It's the same message that is going to swap certain asset at this limit to a certain outcome asset, right? So that would be my answer. My answer is I don't know. So
Okay.
long story short, I don't know exactly, but
Well,
yes.
the whole construct of smart contract wallets and stacks, it's still, I would say, it's still very nascent. I do think what AIBTC is doing and Bitflow is doing with Keeper, and now with JingSwap V3, with this execution layer using these Keeper contracts, I think it's phenomenal just for onboarding and just for use cases for smart contract wallets.
Yeah, if you think about it, our customer, a stacking pool, they need to swap every 2 weeks. So they are babysitting the chart. They're trying to get the best rate. Really, they are not doing it randomly. They're trying to get the best rate. What if they could, delegate this to an agent with a policy? The agent cannot act outside of the policy, and the ownership of the asset stays within the vault, which is owned by the owner itself. So it cannot be hacked. Again, it's a very simple primitive that I think has a ton of implication, and in this case for JingSwap, for a stacking pool, but it could be for other types of users. That again, I think in terms of UX, it's a huge advancement here that has the threat of competing with, the centralized exchanges, because centralized exchanges, their edge is it's easiness and speed. But now you swap that thing with, getting the best rate, and you don't need to have user availability. A keeper can do the job and will report whenever the outcome arrives. So you're hands-free in terms of the user. You don't have to stress, look at charts and so on. I think that user experience has the potential to disrupt the edge of easiness that centralized exchanges had.
I like the way you put that. Now, before we wrap up our conversation, last on the list was, what are some developer technical lessons learned throughout building JingSwap contracts, and just in general, just the whole design of the back end, the contracts, and the front end? What are some lessons learned that you can share with developers?
I think the right process for building, dApps is to go from the use case with a real user where you have that feedback loop and build by iteration. You got to go fast. You got to cater for the use case, get the product out there quickly. The problem with that is if you get it out there quickly, it can be risky if you haven't unit tested. So that's a given. So do the minimal amount first. Doesn't have to be perfect, etc. But at least it's safe, it's out there, and it works. And then you get that first feedback, right? So V1, was not atomic because I wanted it to be safe, right? You close the deposits first. You cannot see the price. It's in a minute from now. You have that sanity check against V2, against Bitflow and the other two gates. V2 was let's make it even more secure. The user now is stating the limit price. That's even stronger than a sanity check against Bitflow. That's even stronger. No questions asked. And this takes digestion. Yeah, you have to build things. You have to have your hands in it. You have to dream about it and understand and feel it in your bones that this is safer. Okay, great. So now that this is safer, I can make it atomic. Why? Because if it's atomic, now the liquidity can be bridged to all venues on stacks, to Bitflow and others, to future venues, to anyone. And so this makes it atomic. That's great. Now it is a primitive then that others can build. Jing Vault is building on top of Jing markets. It's atomically, it can be atomic or not, but like making it atomic allows to, take the result of it, a result of such a swap where everything happens together, deposit, close, and settle. And with stacks, also increasing their capacity at the chain level makes it possible too. So I would say, like security first, ship fast, iterate, make it better and more secure. And then the next step would be, expand your use case. We have cleared almost $300,000 of SBTC STX swaps. We're getting only known within the stacks community, getting known for it to be safe, right? V3 is almost the same code as V2, right? It's very small increments, so we're not risking it, right? We want that market to grow. We want our whales to come to stacks and have that market. We're open to talking to market makers. Market makers are a typical user segment for JingSwap. They could market make across JingSwap and a centralized exchange. But we also want to expand because you can also imagine one of the huge pain points that Bitcoin OGs have is to take profits. And now with all of what has happened on stacks, SBTC was launched, now it's battle tested. USDC on stacks was launched. It's called USDCX. And that is also something that people trust. Well, being able to go from Bitcoin to USDC directly on chain is now possible. And this is what we want to bring with JingSwap as well. We want to cater for that, for those large whales, but also for the agents, to be honest. Like the agents are also going to want to, improve the rate, even if it's a small amount. A small amount counts for them. And so making it atomic also allows for, agents to swap really fast.
Every time I've always been a fan of you, Rapha, and the amount of enthusiasm and genuine passion that you exude is just contagious. And it's always a pleasure talking with you, whether it be on video or Discord or on Twitter. And I'm always just amazed as to like the things that you're building to better the Bitcoin ecosystem. To wrap it up, thank you once again, Rapha, for diving deep in the code and in your JingSwap project and how it all works behind the scenes, and especially kind of pointing out the whole Pyth integration and, kind of the precarious nature of what to look out for when using Pyth. Thank you very much. And yeah, hopefully we can get you back on another show. So
Yeah, I have more and I can go on for a lot, but I just want to, before you close it, I want to give a shout out to the creators because I also want to make JingSwap creator first. But that can be a different episode, and I hope that
Touche.
you will continue. Yeah, I hope you will continue for the sake of Bitcoin and Bitcoin L2, to provide all that value to us, the developers. So thank you for this.